Hello, and welcome to the Making Sense of Markets for the third quarter of 2017. My name is Josh Kanan. Partner Ari Crandall will be your host for today's segment and should take about 10 minutes for the presentation total. Let's open up our discussion of the markets with some comments regarding the relative calmness of volatility characteristics of U.S. markets during 2017. We've definitely seen very low volatility. A good way to frame this discussion is to kind of look at historical maximum drawdowns for the S&P 500. And just so you understand what a drawdown is, it's basically a peak to trough decline. So an analysis of these annual maximum drawdowns for the S&P 500 going back to 1990, you see the following results. The average maximum annual drawdown throughout that entire time frame is about 9.4%. You can see that with the red line on the screen. Year to date, the maximum drawdown that we've seen is only 2.5%. So we're well below the average in terms of volatility and drawdowns. The largest maximum drawdown that we saw during this time frame was 38%, and you can see that was 2008. And the smallest drawdown was 0.36%, which has happened in 1995. And I apologize, I mentioned 1990, but this actually goes back to 1980 on this data set. So meanwhile, on November 22nd, 2016, the S&P 500 closed above 2,200 for the first time, and since then has set 43 new highs. So yes, recent volatility is certainly low, and if it were to spike some, it shouldn't be so worrisome to investors as we're currently just below normal levels. Further, retreat from equity markets in 2017 for fear of a snapback in volatility would likely have cost investors some measure of participation in the rising equity markets. And we saw a lot of people saying, well, maybe we should get out. Markets are all, so high, and that happened and was told to us about a year ago, and people would have missed out on all those returns that have happened so far this year. Finally, as a reminder, diversification can dampen the impact that any one portion of your portfolio can have on the overall portfolio. So even if volatility were to pick up in the US, a globally diversified portfolio should help mitigate some of the negative impact resulting from this occurrence. It's important to stay the course, maintain a globally diversified mix of assets aligned with your given tolerance for risk.
All right, so now we're going to take a look at world and regional performance for Q3, quarter three of 2017. Let's begin by looking at a macro view of performance around the globe. Returns often differ in stock markets, worldwide, and this quarter was no exception. A snapshot of performance for the first quarter shows that returns were positive in North America, but even higher in other regions around the world, partially due to a declining dollar, which fell 2.7% during the quarter. Returns in US dollars for the quarter looked something like this. While all major regions produced a positive return for the quarter, North America recorded the smallest gain. Latin America was the strongest performing region for the quarter. It gained 15.1%, followed by Europe, the Middle East, and Africa returning 6.2%. Asia gained 5.5%, and finally, North America returned 4.5%. Just another reminder why you want to stay diversified in your portfolios. Winners will always rotate, and this is a perfect example of that. Now we're going to take a look at performance by company size and company style. In general, during the quarter, we saw positive results for most asset classes, with small growth companies leading the way in both US and international markets. Looking back over the last 15 years, we saw a similar trend. Both US and international stock markets were rewarding investors who stayed invested, specifically in small and value segments. In the US, a tilt towards small company stocks versus large company stocks has rewarded investors with a 15-year annual premium of 1.1%. That's the difference shown here by subtracting the average return of US large company stocks from the average return of US small company stocks over the same period. However, investors tilted towards value versus growth have experienced relative annual underperformance of minus 0.6% on average. We arrive at this calculation the same way by subtracting the average return of US growth stocks from the average return of US value stocks over the same period. Internationally, investors have tilted towards small and value stocks, captured average annual premiums of 3.8% and 0.4% respectively. Similar to our calculations of premiums that we showed you in the past, we subtract the average 15-year returns for international large growth stocks from the average 15-year returns for international small and value stocks respectively. In general, investors who stayed invested and followed our strategy of tilting their portfolios towards small cap and value companies, both in US and international allocations of their portfolios, were rewarded with higher returns than non-tilted portfolios over the same period.
Looking at the most recent quarter's asset class returns, we see asset classes in your portfolio ranging from positive 7.3% for international small cap to, on the high end, to 0.3% positive for cash on the low end. And you can see that there as I highlighted on your screen. Maintaining a diversified asset mix, such as the 65% stock, 35% bond mix shown in white, which you can see here, and it's highlighted there that I'm circling now, kept you away from the more extreme returns from year to year with significantly less volatility over the last 15 years, highlighting the importance of maintaining a well-diversified mix of asset classes in your portfolio. We've used this chart many times before. We call it the Skittles chart, and it really is powerful just to understand that you're not always going to be at the bottom, you're not always going to be at the top. We kind of want to just have that more consistent approach, and whether you use this 65-35 or one of the other models that we build, it keeps you from being at those extremes.
Okay, now we're going to take a look at how the different asset classes contribute to total returns. On this slide, we look at the absolute impact of those different asset classes on a sample, moderate allocation, 65% stocks, 35% cash and bonds. We look to see that the largest impacts of performance were driven by international large value stocks. Take a look at that, almost 1% additional right there. US large cap stocks, international small cap stocks, and US small cap stocks. The overall gain on this index mix for the second quarter was 3.4%. So just another example of why diversification is important. As you can see, you pick up additional premiums and returns by keeping a diversified portfolio.
Now looking to the headlines from the third quarter, the majority of news outlets were quick to kind of extrapolate the trend, as stock markets were rallying around the world and continued to rally. Investors who were at first worried if the current bull market would continue to run well into the future were quickly reassured by CNBC that, in fact, this bull market could continue forever. Yahoo Finance shortly after mentioned that we were in a Goldilocks economy, not growing too fast or too slow, so the bull market could continue. Later in the month, we heard from Forbes and Advisor News that neither an interest rate hike, war, nor politics can stop this stock market. So definitely the talking heads were been in full effect this quarter, talking about this bull market. Yet we know empirically that bull markets do not last forever. Looking back to the past nearly 50 years of stock market performance, we observe that there are many cycles, both up and down, and that the length and magnitude of those trends appear to be random. Yet there are still some important takeaways from this chart that you see on your screen now. First, there's no preset level which mandates when a market's going to rally or fall. In other words, there's no way to time when to get in or out of the market. And Ari and I talk about this all the time with our clients. We don't know if the current bull market's going to last another decade or maybe just another month. Secondly, whenever that downturn does occur, and it will, it's been fairly short in length, averaging less than a year and a half in the bear market since 1970. And you can see 4 of them on your screen here. They're very short in timeline in comparison to those big bull market runs.
So this is the cycle of market emotions, and we talk about this quite a bit. And returns have been strong and steady through 2017, and volatility has all but disappeared from the market thus far this year. And it's always a good reminder that it's easy to downplay concerns about risk when the markets have been going straight up for several years. In this quarter's newsletter, a professor of behavioral finance and a Loring Ward Investment Committee member, Mayor Statman, had the following quote: "A word of caution about reacting to strong market returns. Some investors may be tempted to take on higher risk profile or portfolio than is warranted for them because good times can mistakenly lead them to believe that they may be able to handle more risk than they really can or should. Some investors can forget that markets don't always go up." And that's exactly what this chart illustrates. As markets are on the rise, which you'll see right here, oftentimes you think, hey, market's going up, it's time to buy. And then eventually when the markets take a dip, you have some concerns. This is only temporary. And hey, you know what? I got to get out of the market. I can't handle this anymore. We hear those comments quite a bit. And then, the other comment we hear is, when the market gets better, I'll jump back in. Now, we all know that when the market gets better, I'll jump back in. That represents you buying high. And when I can't handle this anymore, I got to get out. That's you selling low, which is emotionally maybe a good thing to do, but financially is disastrous to a portfolio. When the markets are at a dip, that's when you want to actually invest more money. Nick Murray, who's well regarded in financial advisor circles, he's got a great quote, and he says that the dominant determinant of long-term real life return is not investment performance, but investment behavior. So basically, don't let your emotions drive your investment decisions, is what that is saying. So Josh, how do people avoid the pitfalls of emotional investment?
Yeah, Ari, there are some steps that you can take to reduce the impact, of kind of these market ups and downs on your long-term plan. One of the big things we talk about is having a rebalancing strategy, which is, taking advantage of actually selling high and buying low, which is the opposite of what you just mentioned in the cycle of market emotions. I think another important thing during times like this is to review your risk tolerance. Make sure that you understand the amount of risk you're taking, what your downside would be if you had a big market turn down. Evaluate progress towards your financial goals. Are you on track? Are you getting close to what you kind of set out when you started your plan? And then assess any changes to liquidity needs. I think it's extremely important to make sure you have enough liquidity, enough in cash or short-term high-quality bonds in order to weather any storms that may come about in the future. And then, make sure you mention any special tax situations to be aware of, because, as we get into the end of the year, you certainly want to be cognizant of maybe some tax loss harvesting and some other things to be thinking about. So I think that all these topics are worth discussing during your next review meeting with your financial advisor. So that concludes today's presentation. I want to thank you all for listening. And as always, let us know if you have any questions or concerns. Thank you very much for your time. Ari, thank you as well.
Have a great day. And when in the call, we're always happy to discuss any of these topics in more detail or sit down and make sure that your allocation is still relative to your goals.